Okay, so this is financial modeling. And by the time we start going deep into it, you will see different method or different modeling we have. But for the course of this training, we'll be looking at building a three-statement financial modeling in Excel. So my name is James Olashore, and this is our mission to build. We can see the chart. This is what we want to do for the course of this training. But before we'll be able to build this, we have processes we have to follow, and the other aspects we need to learn. So this financial modeling is really practical. If you go to companies now, that is, I mean, maybe like audit firm or some firm into consulting. So this is what they do. Company will give them some information, and then they build on that information and carry out the possible outcome. Maybe they want to go into one project, or they want to start a particular project, and they need to actually forecast, see what is likely to happen. Sorry, I'm trying to attend to someone. So they see what is likely to happen if they actually go into that particular project. And that is what all about. So we start now proper. So let's start. What is financial modeling? So a financial model is a tool used to forecast a business financial performance into the future based on historical data and assumption. So you must, before you can build financial model, you need two things. You need the historical data, and you also need the assumptions. So historical data may be from year 2, from year 1 to year 3. That is what you have previously. You use that as historical data. You also assume, okay, in the next 2 months, we want, or in the next 3 years, we want this revenue to grow. You see the trend, the movement of that revenue from year 1 to year 2, from year 3 in the historical data. That is, maybe you want to forecast for 4 years. So you will need historical data for 2 previous years and 2 years ahead. So it means if we want to forecast in 2023 now, we need 2021 and 2022, or let's say 2022 and 2023. Then our forecast will now based on 2024 and 2025. So we use what we have presently to forecast to what is likely to happen in the next 2 years. And then the assumption is always come from the management of the organization. So they are going to be the one to give you the assumption, and then they will provide the historical data as well. Now, based on this, why do we build financial models? For anyone pursuing a career in corporate development, investment banking, PFA, equity research, commercial banking, and other areas of corporate finance, building financial models is part of daily routine, because they do that almost every day. in banking industries, investment industry, because they can't just go into any investment without forecasting, without looking at what would be the outcome. Then from there, they will be able to make their decision. Now, corporate decision. The corporate decision, like companies, they also make use of this financial modeling. Company performance strategies plan. So they want to know what should be their plan. What will their plan be like in the next few years, in the next 3 months, in the next. So they do that often to actually see or to forecast what is likely to happen. Then project finance. For those who are into projects and something like that, whether to invest into a project or not, just like investment appraiser. So they are going to look at, by the time we look at different modeling you will have, you will link it with your PM, investment appraiser, or SFM, your investment appraiser, and you'll be able to see how close they are. Then also we have corporate transactions. Maybe during the merger and acquisition or capital raising, you also make use of financial modeling to actually see if the company you want to merge with is actually a good company, maybe a company that will be able to add positively to the parent company. So if a company, you analyze the historical data now for both for 2020 and 2023, and you see that they continue to make losses, that may not be the end of that forecast. You can still decide, you can decide to forecast in the next 2-3 years what will likely happen to this company. So by focusing on that, you'll be able to determine if the management has actually put some things into that company that it will generate adequate revenue, or that would bring a sustainability or going concern into that company into next 3 years or 4 years. So that will actually help you to actually make your decision. Also, investment decision, evaluation, equity research, and portfolio management. All this will help you in as we move on. Now, let's go to the next one. Now, types of financial modeling. This is what I'm trying to say. So we have different types of financial modeling, but for the course of this training, we will base on 3 statement model. So we have DCF model, merger model, initial public offering model, leverage buyout model, sum of the parts model, consolidation model, budget model, forecasting model, and option pricing model. So all these are all modelings, but we are only focusing on 3 statements model for now. So if you have any question as we move on, please don't wait to do that. So now under 3 statement model, we'll be looking at income statements, balance sheets, and cash flow. Those are the 3 statements we are talking about. And those are the 3 main things we need for you to actually forecast for your company, or for a company that wants to know what would be their fate in the next 3 or 4 years. So you only need to forecast on their income statements, balance sheets, and then cash flow statement. Then under this DCF analysis, we are going to look at, though we are not treating this, but it will be covered under discounted cash flow analysis to value a business. Then we also have scenario analysis. This will estimate changes in the value of business in different possible scenarios. Maybe it's going to be live case scenario, or in uppercase or lowercase, or as the case may be. Then we also have M&A analysis. This evaluate the attractiveness of potential merger, acquisition, or the structure. Maybe you want to merge one company together, or you want to acquire a company. So you make use of this model, which will be more effective to make use of this. Then we also look at capital raising. If a company actually wants to raise a capital, they will look at what are the options they have. Are we going into debt way of raising capital, or are we going into merger and acquisition for us to get more, or are we going into equity? Are we supposed to sell some of our equity to get more funds to actually raise capital? All this would be part of what they are going to look at when you are looking at them. We also have leverage buyout analysis. This will determine how much leverage can be used to purchase a company. So all this I don't study. That is not where I'm actually going today. I just want to wet the ground before we start. Then I'm going to show you the formulas we'll be making use of. Those are the area I want us to focus on. Now, key structure for modeling or for model building. For good models, clearly separates inputs, processing, and outputs. So for every model, you must have inputs, you must have processing, and you must have outputs. So when you say inputs, those are the assumptions you have. You must be able to put your assumption, put everything you have to gather, the information you need to gather to build that particular model. Then when you processing begins when you start putting your figures and building your statement together. Then the output will be what is your decision based on the graph you have, based on the charts you have. In this one also we'll be looking at how to actually represent what we have been able to build on a graph, on a chart. We make use of that chart as well when we get to that point. Okay. Now looking at this, we have complex versus simple model. So we have two types of model, or let's say three, but I'll be looking at these two. We have complex and we have simple. So in this case, we'll be looking at the simple models. So when we look at the first one, which is a simple model, it's going to be basic, easy to follow, lack of precision, and overly simplified. We are going to make it very simple for you to actually know how to build it. If I want to go to complex, that's when I'll be making use of advanced Excel and be linking and the trace present. So in this case, I will not be making use of all those ones. I want to make it simple for you so that when you get the case scenario we are going to make use of, it will be very easy for you to build your modeling on your own. And if you have anything you have to do or any question, you can actually let me know. You can chat me up, so I will gladly respond to that. Now, best model, keep things as simple as possible while providing enough detail for decision making. So don't make too much of details. So when you make too much of details or too much of formulas, then that's when you get confused. And once what you are doing is not accurate, it means you are giving wrong information to the management or to the clients, because this is now a real business now. If you are able to build, if you can build financial modeling by yourself, companies can engage you, they can give you, because many companies now, they want to know their future. They want to know what is likely to come up in the next years, in the next 4 years, in the next 3 years. So most of them are actually going into financial modeling now, so which you need to actually know how to do. Then, not only that, After that, we also have what we call outputs. So when we say outputs, we provide key results to aid decision making. What is our results from our data, from the input we have, and from our processing that we've been able to actually. I think my network is not stable. So decision making. So your output we have, we help management in making their decision when you are done with your modeling. Easy to understand. You must make sure your result is very easy to understand. So not too difficult. Make your graph so simple, make your formula so simple, and put some key narration for them to actually understand, not ambiguous. So achievement or achieving objectives, make output modular, then consider creating a summary section with only the most important key models output. So by the time we start all those ones, you will actually understand what we are talking about. Now, this is what we are focusing on. This is the model structure and layout. So we have multi-spreadsheets and we also have single spreadsheets. So the single spreadsheet means that all the statements will be on a single sheet. It will be on a single sheet, from balance sheet to income statement to cash flow, the schedules, everything will be on a single sheet. Where you can also decide to go by multiple spreadsheets, whereby you will create multiple sheets. You will create multiple sheets for you to put your information or your data one after the other. You can create sheet 1 as an income statement, then sheet 2 as a balance sheet, sheet 3 as your cash flow. The next sheet, you can create it as a schedule. Depends on how you want it. There's no crime in that. Depends on how easy it is. So let's also move forward. I have so many to cover within short periods. Okay, now financial forecasting framework, which we actually need to look out for: assumption drivers, income statements, balance sheets, cash flow, and supporting document. Those are the 5 key things you need to actually build your modeling. You need assumptions and drivers. You need income statements, you need balance sheets, you need cash flow statements, and you need supporting schedules. Now, historical ratio and figure which drive the forecast, which we are going to look at during our practical aspect, summarizes the company profit or loss. We all know the meaning of income statement already. Then balance sheet, this will display the company assets, liabilities, and shareholders' equity. Then cash flow statement, this will report the cash flow or cash generated and how companies spend those cash generated. The cash generated from the investing activities, from operating activities, and from the financing activities. How did they generate it and how did they spend the cash as well? So we must look at it too. Then the supporting schedule, we'll be looking at the breakdown, long calculations such as a PPE, the debt schedule, and the other aspects of it. So these are the key area we'll be working along as we move forward. And I'll be sharing with you and explaining how to actually get those formulas right. Because in this modeling, you need to know the formulas and link most of the aspects together. Because if you fail to link it, you may decide to change one assumption. And if you change one assumption, it means you will start all over again if you fail to link it. So you have to link all these figures together to the very last point. So the extent that if you change one of the key drivers or one of the assumptions, everything will affect it from beginning to the end. So we'll be looking at that area as we go. Now, for the assumption, we need historical data, and we also need the assumption and drivers. Those are the two things we need. Then for forecasting revenue down to EBITDA, that is earning before tax, depreciation, and amortization. So we are going to look at that step by step. We also need to work on working capitals. How do we generate our working capital? How do we calculate working capitals from receivables, inventories, and payables? We also need to know how to do that. Then we also need to forecast our capital asset, that is PPE, CapEx, depreciation. If there's any closing, if there's any opening, we must also know how to look at that area. Then forecast capital structure. What are the capital structure? When we are talking about the capital expenditure, capital structure, we are talking about the debt ratio, what is the value of the debts, what is the value of the equity to this company, and what are the repayments, what are the additions. We'll be looking at those areas. So I have a very robust, comprehensive case scenario, live case scenario that we are going to look at in this practical. They also have a complete cash flow statement. We must be able to complete our cash flow statement based on the case scenario will be given. So that case scenario will be used as our practical. Then also, apart from that, as we have said, we have complex and simple. So we'll be looking at the ratio and then regression and the lives under complex. But we are not looking at the complex under this practical. We are looking at the simple aspect. We want to make it more simple for everybody to understand. We are going to make use of historical figures, the trends, and we also predict future growth. Like maybe they want their revenue to grow for 7%, or they want their cost to reduce by 5%. We'll be looking at all those ones as we continue. Okay, when we talk about historical figures, trends to forecast future margins, we can decide that our revenue is 100% increase. That is, we want to, in the next 2 years, we want to make our revenue to be double. If you are earning 50,000 now, we want to make our revenue to be 100,000. And our cost to that effect of revenue, we want to make it 80%. So which means that our gross margin will be 20%. That is 100 minus 80 will give us 20%. Then we can also reduce our other expenses as we move on. Okay, I'm trying to move faster because this is not where I actually want to treat. I'm just trying to lay the foundation before we get there. Now, working capital equation, I believe you all know this equation already. We know we have receivables. We have, when we are talking about normal receivables, it's going to be receivables over sales. Now, this sales, if it is, there's credit sales in our question, we are going to make use of credit sales. But if we are only sales, then we make use of sales and multiply by 360 days. Then if you are trying to forecast it, so we are going to make use of receivables divided by the 360 days, then multiply by sales. All this one will be looking at the formula in the next materials I'm going to share with you. So let me skip all this. Let me also skip all this. I think I've explained this already. So under non-current capital assets, we'll be making use of this PPE, CapEx, that is the addition to capital expenditure, depreciation, and also, if possible, we can be looking at the intangible assets as well. I believe you all know what we call intangible assets. And this is what we call the capital structure I was trying to explain. whereby we have the debts and we also have equity. So we look at the two as we also move on. Financial covenant dictates maximum leverage and maximum coverage. Consider management willingness to take on debt. So some management, they prefer to go into equity than debt because many of them don't want to take the risk of going to the debts, get high interest and the like. So they prefer to sell some of their shares to the people so that they can get more funds to run the business as they move on. Okay, use the company's current assets to the debt and equity capital structure. All this one will be adequately treated. We will treat it as we move on. Then under this one, we look at the opening debt balance, additional repayment, interest, and then closing debt. Okay, a financial model is a tool that relies on a set of assumptions. So we build models on assumptions. So what are the things we must be very careful of? We must make sure that our assumptions are very, very correct, if not 100%, because we are only estimating, we are only forecasting. So they may not be accurately correct, but we should make sure our forecasts are something that is feasible. For example, you are selling a laptop and currently you are selling 100 units in a month, and you say, okay, in the next 2 years, I'll be selling 200 laptops in a week. That may be possible because currently we are in 21st century, that everyone are going online and everybody needs laptops nowadays. So in that case, you may be thinking of that area as possible assumptions. But in a case whereby someone that is into another business and you are forecasting and your business is not something that is going concern, that by the time you look at it in the next future, you may not even find that business again. So in that case, your assumption must be something that is reliable. Now, step for building the three statements model. The first one is the copy and paste raw data into the blank model, format and link, that is the historical subtotals, calculate historical ratios. We are going to be referring to these steps as we move on. Then make assumption based on the guidance provided. This would be the assumption given by the management, and that is what you are going to use to actually build your modeling. Then also we start the income statement based on that modeling or assumption you just have. You start building the statement. Then start the balance sheet, start your supporting schedules, then build the cash flow. Cash flow would be the last, almost the last one you are going to build. As we move on, you see, then charts or graph or output will be the last thing you are going to do under this step. Then after that, you can find this link on the attachment tab. You can download case study and the like. So I'm going to send this case study to you for you to actually study ahead before we start the practical aspect. So I'm going to share the formula with you and step by step. So this is what we want to build. This is our focus, and it's going to be on a single sheet to make life very easy for ourselves. So I want to stop sharing this so I can share my normal formula with you. So we are starting with this now. Okay, so I believe everyone can see this. Now, the first thing to do is that your management, how you prepare your management account will actually help you in preparing your financial modeling. If you can prepare your management account, then your problem is half solved. Financial modeling is not that difficult, but you need knowledge of management account because you are going to be building income statements, cash flow, balance sheets, and schedules. And all these things are what you have done in management accounts. So the first thing is to refresh your memory or your knowledge on management accounts. If you are good on that, no issue. Let's go to the next one. Now, let me share another material with you so that we do the two simultaneously. So I'm trying to open the material while we continue. So we need to arrange the years. The way we arrange years under financial modeling is actually different from how they may give us this particular question, which we are going to be looking at. So our financial modeling, we have a way of, okay, so let me share that with you now so that you actually see what I'm trying to drive at. Okay, I want to believe can see. Okay, so let me stop sharing this. Okay, so this is what we want to build, and this is a blank sheet of the training material we are going to make use of. So if you look at this now, we have 4 or 5 years for historical data. This historical data will be from 2013. So we are assuming that we are in 2017 or 2018, early 2018. So these are the historical data, and this will be based on what we have been having in the previous year. Then we are going to forecast. In this forecast, will now be based on assumptions. What will be the increase? What is likely to happen in 2018? What is likely to happen in 2019? What is likely to happen in 2020, 2021, 2022? This will be the basis of our drivers or assumptions, which we'll be making use of. And if you look at it, you will see that it actually looks like our this is income statement, and this is the normal ratios we'll be calculating. So if you have done your ratio analysis in FA, I mean in a CFR, in CR, it will not be very difficult for you to calculate. And if you have not done it, we will do that in class as we move on. So we'll also be calculating the income statement, we'll be calculating the balance sheet, we'll be calculating cash flow statement, and then we'll also be calculating our supporting document. Now, we'll be also be calculating or representing our information on graph as we continue. And this will be our raw data. This raw data you are seeing here is just an assumptions. So I'm going to give you the full case, just like an assumptions that we'll be making use of. Okay, so let's go back to what I'm trying to explain now. Based on each of these formula, we need to actually work with. So let's go back to the formula. So it's going to be step by step. After you have done this, in financial modeling, we have our ways of doing things. Anywhere we use formulas, we color that place or that particular area with black color. But anywhere we make use of only ordinary figure, direct figure, we make use of blue colors so that once you see it, without anyone telling you, you know that this is ordinary figure, direct figure. And when you look at it, you know that this is just ordinary. I mean, this is a formula area where you have been able to use different kind of formulas to actually get your assumptions. Now we also make use of formulas, different kind of formulas we'll be making use, and the balance of three statements, and or based on the historical data. And okay, so we are going to prepare supporting schedules, which will be based on the working capital. You all know what we call working capital. We'll be making use of trade receivables, inventories, and also our trade payables. Then we'll be looking at schedules for PPE and then debt interest. All this one will be calculated as we move on. Now, this is first step. The first step is this. Now, let's look at what is the first thing we need to do. Now, we need to actually, they are going to give us the historical data, information. That is their income statement, their balance sheets, their cash flows. So we are going to prepare that financial statement first, like a management account, and that must be balanced. The next thing to do is to calculate the ratios based on that historical figures. So what we have on the historical figures, revenues, cost of goods sold, we are going to make use of all the key line items there, and we calculate their ratios. And if you can see from my screen here, you will see the formulas stated there. Current revenue divided by previous revenue minus 1, cost divided by revenue, salary, that is the cost, staff salary divided by revenue, then rent. Rent is a fixed cost, so there won't be any growth on that. So just make use of direct figure, because rent is a fixed cost, and a fixed cost will not react to any changes in growth or whatever, except if there's an incremental cost, and that we may not be looking at that under this topic. So these are the formulas. These have been sent to you already. So to calculate the inventory days, we also have that already. So we have inventory over cost of sales multiplied by 365 days. Then for account receivable days, we have account receivable divided by revenue multiplied by 365 days, and those are the formula. So once the first step is to use the information given to you to prepare a management account based on those years they give you. After you have prepared the management account of that particular information, calculate their ratios. After the ratios, then go to assumptions. That is the C part now. We go to C part, make the assumptions. Assumption will always be different from historical data. We'll be given, you must have two data, the historical data and assumption of forecasting data. Those are the data you're going to use to forecast the future. And they're going to give you on ratios, on a percentage, and you'll be making use of that as you calculate. The formula will always remain the same thing. But all this one, you can see that I color them in blue, which means that they will just be a direct figures. There's no need of making use of any formula. They will give you all this assumption, right, live and direct. But in a live scenario, you want to build for company A, they may not be giving you all this assumption. The management may not be giving you that assumption. You may be the one to sit down on your own, do your research, if this company is making 20 million in 2 years, in 2 months, how much can they make in next 2 years? How much can they be making in every two months? What kind of business are they into? They are into transportation. They are into food selling. They are into fuel. They are into oil and gas. In the next future, will they be able to make that particular revenue? Are they going to incur that particular cost? Are they going to, like a banking industry now, if their salary, their cost on salary is 20 million, in the next 2 years, are they going to incur that particular 2 million again? It might not be possible, because this is 21st century. They are making use of ICT now. They are making use of technology. So the more you make use of technology, the lower you need more people to come in, and that may be replacing the individual to work in the banking industry and the like. So we also be looking at how to make use of this when we get it. So I want to entertain question now, but let me look at the second part of that formula so that we conclude it. And if there's any question, we can tackle that. So just give me like a few minutes to work on that particular document, so that I can share the second part of that with you. Okay. So I believe you have your questions ready, so don't worry. We are going to be attending to that shortly. Okay, so this is the second part of the formulas which we are working on. And here is almost the last part of it. So looking at it now, we have them building the modeling now. So from here, we are going to make use of the revenue, and the formulas are there. These are the steps you'll be taking one after the other until we complete our model. So we'll be making up of the salaries, and the formula will be making use of revenue times the cost rate forecast. So they are going to give us all these rates for assumptions. They can put it like this: the management is assuming that the revenue will grow by 20%. So these are the rates we'll be making use of to actually forecast the future. Then we will also be building our balance sheets, be making use of different area, the cash, the receivables, inventories, property, plant and equipment, account payables, equity, debts, and retained earnings. We will also be looking at our cash flows, whereby we calculate all our cash flow statements from investing to operating and to financing activities. Then we also look at the supporting schedules, which will be calculating working capitals, the capital schedule, and the likes. Then after everything, we represent our information on charts, So we'll be making use of all that area as we move on. Okay, so before we move on, if you have any question based on that, please you can ask now, and let's see how we can answer the question. So if you have any question, please you can ask your question, and we are ready to answer. Before I show you the last aspect of it. I want to believe you have knowledge of management accounts. If you have that knowledge, that is the main thing you need to know for you to build this statement. If you don't have that knowledge of management accounts, no problem. You can easily go to my YouTube page. Just look for incomplete record, look for cash flow statements. You will see management account there, even if it's not complete, but you are going to make use of the incomplete record. You are going to make use of the cash flow. The cash flows is complete, and then incomplete record also is a complete section. So you can watch it before the next class, so that as we move, you will be able to assimilate what we are trying to achieve right from the beginning. Okay, so these are the aspect of it. So I'm just using this to wet the ground on what we're about to do. And it's going to be very interesting because it's going to be practical, and you will also have opportunity to participate. We ask questions together, we discuss, and I'm going to give you a model, and this material will be also sent to you to practice your own based on what you have done in the class. So you can share your own model with me. Then you can represent your information in any way you want to represent it. Either you want to use the bar charts, the line charts, or whatever chart you want to make use of. So we'll be making use of every possible tools we can make use of. Okay, so if there's any question, if you can please ask. If you have any question based on that, you can ask. Then there's something I forgot to also tell you. In financial modeling, you will see that I remove anything grade line here. So I remove what we call grade line. You will see that this is not how Excel look like, but the standard for Excel is that the grade line must be removed. You can see that we have the grade line now. This is how our Excel look like. But when you are building your financial modeling, all these grade lines, all this line you have on the Excel must be removed for you to have a clean and neat model. So by the time you make everything empty, you will see that it will look more neat because of your graphs and the output you actually want to give to. And this is the int. So I'll be sharing this also with you when we are done. I will be referring to these formulas as we also go on with this practical. So the practical aspect will be coming up in March 4th and 5th, which is the next week. Next week, Saturday and Sunday. So we won't be able to finish it in one day. So we will need to make use of 2 days because I don't want to rush it. I want to make it so simple and very, very easy to understand. So this is what we'll be making use, and this is the data. So I'm going to share the assumption with you. I will share the assumption. I will share the data we are going to make use of, and I'm going to share this int with you also. So for you to start practicing, go back to your management account. So financial modeling is very similar to management account. If you have knowledge of management accounts, then your problem is even more than half solved. So all you just have is just to have the assumption and apply your assumption on your modeling. Okay, so if there's no question, I'm going to wait for like 2 or 1 minute if there's any question. So if there's no question, then I will close the meeting for now until we meet for practical aspect. Okay, I think I have a question. Sir, please, what is your YouTube page? Okay, just go to House of Accountants Professional Services. So it's what you are seeing on this place. Just go to this YouTube page, House of Accountant Professional Services. Search for the name. You will see us there. So try to watch the management accounts. What's the management account? Prepare. Refresh your memory if you know it already. So if you know that already, then there's no issue. It will be very easy for you to assess or to prepare your modeling, and then as we move on. Okay, so I believe that one is clear. Is there any other question? Okay, so it means there's no other question. So thank you very much. I'm going to share the assumption with you and the material we are going to use. I'm going to drop it on the platform. You can start looking at it, start working with it until we meet in the next coming week. So thank you very much for coming and have a nice day.
Thank you, sir.
You are welcome.
Thank you, sir. God bless.
Thank you very much, sir.
Welcome.